Imagine a stock that just rocketed nearly 100% in pre-market trading, just like that, off a single press release. Sounds like, well, every investor's dream, right? But what if we told you that even with this massive surge, this company is still seen by many as an extreme binary bet, where the most likely outcome for investors is, frankly, a total loss of capital? Welcome to The Deep Dive, the show where we take your pile of information and really distill it down to the most important nuggets of knowledge. Today, we're taking a deep dive into the fascinating and, pretty volatile world of InMed Pharmaceuticals, ticker INM.
That's right. We've got a comprehensive stock research report here on this microcap biotech. It's dated June 24th, 2025, and the share price at the time was $2.49. Our mission today is to really unpack the fundamentals, get a feel for the market sentiment, and importantly, lay bare the risks so you can truly understand what's driving this high-stakes wager. And we'll be announcing the full chapter titles clearly as we go, guiding you through every layer of this, well, quite intricate analysis.
Okay, so we're going to break this down into two main parts for you. First, we'll look at the core business itself, the management team, and cold hard financials. Then we'll pivot. We'll look at market sentiment, who actually owns this company, and really dig into the inherent risks. Ready to just jump in?
Sure.
All right, let's unpack this. To really understand InMed Pharmaceuticals, we kind of need to start with the basics, the foundational stuff.
Exactly. Let's kick things off with Chapter 1, Business Analysis. And just as a reminder for everyone listening, this analysis is current as of June 24th, 2025. That closing share price was $2.49. So InMed Pharmaceuticals operates with, well, it's a kind of dual segment model, a bit unusual. On one side, you've got InMed Pharma, that's their core R&D engine. It's all preclinical, pre-revenue, focused entirely on prescription drugs. This is meant to be the long-term value driver, but we're talking years, maybe even a decade, from any potential product on the market. Then there's BayMedica. They acquired this back in October 2021. This is their commercial arm. They manufacture and sell rare cannabinoids, things like CBT, CBC, CBDV, as bulk ingredients, mostly to the health and wellness sector.
Okay, so BayMedica is the part actually bringing in cash then. That's their only revenue source.
That's correct. It is their only source of revenue right now. For fiscal year 24, BayMedica brought in $4.6 million, which was up 11%. And in the most recent quarter, Q3 2025, revenue was $1.26 million. That's up about 8% year over year. However, and this is really the crucial catch, BayMedica's revenue, it's nowhere near enough to actually support the company. Just look at Q3 2025. The net loss for the whole company was $2.12 million. That loss alone swamped everything BayMedica brought in.
Wow. Okay, so it's not even close.
Not even close. And on top of that, their gross margins from BayMedica are actually declining because of more competition. It's really just a minor operational sideline. It slightly offsets the high cash burn, but only slightly. The company's ultimate success, or, well, failure, it really hinges completely on that InMed Pharma pipeline.
Right. So if the commercial side isn't really cutting it, what are the key drug candidates they're pinning their hopes on in that InMed Pharma pipeline?
Okay, so their pharmaceutical pipeline, that's the core strategy. The most prominent asset they have is INM 901. This one targets Alzheimer's disease. It's preclinical, so very early stage, and it's an oral treatment. Now, what's potentially important here is its target neuroinflammation. This is different from a lot of the failed Alzheimer's drugs that went after amyloid beta or tau.
Interesting distinction.
Yeah, and just recently, on June 24th, 2025, they released some preclinical data. It showed a significant reduction in key inflammation markers, things like IL-6, IL-1, NLRP3, and also neurodegeneration markers like NFL. That sounds promising, right? But we have to stress, this is still preclinical, the absolute earliest, riskiest stage of drug development.
Got it. Preclinical, high risk. What else is in the pipeline?
They also have INM 089. This one's for dry age-related macular degeneration, or AMD. Another preclinical candidate targeting something called geographic atrophy, or GA. It's formulated for intravitreal injection, so an injection directly into the eye. Common for AMD, but invasive. Again, years from potential commercialization. And finally, there was INM 755 for a condition called epidermolysis bullosa, or EB. This one actually completed a phase 2 trial.
Phase 2, so further along?
Further along, yes. It showed good safety, but it failed its primary efficacy endpoint. Apparently, there was a really strong placebo effect that masked any potential benefits. So now the company says it's seeking strategic partnerships.
Ah, the classic phrase.
Which
usually means
in biotech speak that it didn't meet their internal hurdles for pouring more money into it themselves. They're hoping someone else might want to take it forward, maybe license it. but it's not their main focus anymore.
Okay, so when you look at the whole picture, the investment thesis really boils down to INM 901 for Alzheimer's, doesn't it? Is that the one drug that's the linchpin?
You've absolutely hit the nail on the head. The investment thesis must be overwhelmingly focused on INM 901. The AMD program is, well, it's a secondary long shot, and the EB program and BayMedica, they contribute minimally, if anything, to the current potential valuation. It's all about 901.
And what about the company's size? We're talking microcap, you said. Just how small are we talking?
Oh, really small. InMed is a true microcap. As of June 2025, its market cap was hovering around just $3.0 million.
$3 million? Wow.
Yeah, tiny. And they only have 13 employees.
13?
13. This minuscule scale makes the stock incredibly susceptible to extreme volatility from even small trading volumes, like that nearly 100% pre-market jump we talked about. A little bit of news, a little bit of trading, and the price can swing wildly. It also means they're, frankly, an unlikely acquisition target at this stage. Too early, too risky, and they rely heavily on external companies, CROs, contract research organizations to do a lot of the actual research work.
So when you strip it all back, what's their core value proposition? What makes them stand out, if anything, in such a crowded field?
Their value proposition is purely scientific. It's all about the R&D. They're developing proprietary, patentable, small molecule drug candidates targeting specific receptors, the CB1 and CB2 receptors. They focus on creating novel cannabinoid analogs. These are new chemical entities, or NCEs, which gives them stronger patent protection. And as we mentioned, that differentiated therapeutic approach, especially targeting neuroinflammation for Alzheimer's. Well, that's the most compelling part of their story. That scientific potential is really all they have to offer right now. Okay, let's broaden the view a bit. We'll move on now within Chapter 1 to the industry analysis. InMed operates at the intersection of two potentially huge markets, cannabinoid therapeutics and neurodegenerative diseases, the cannabinoid market, projected maybe $1.8 billion by 2034, though some estimates see much faster growth, like 20% CAGR for the broader market. But the Alzheimer's market, that's just massive. New drugs like Leqembi are already pulling in, close to $100 million in a single quarter.
Right, so the sheer size of those markets, that's really the core of the bull case for InMed, isn't it, if they somehow hit a home run?
Exactly. That's the dream. One successful drug, particularly in Alzheimer's, would be absolutely transformative. We're talking returns potentially many, many times their current tiny valuation. However, the competitive landscape is, well, formidable, to say the least. In cannabinoid therapeutics, they face established players like Jazz Pharmaceuticals with the Epidiolex. But in Alzheimer's, it's often called the graveyard of drugs. It's dominated by absolute giants: Biogen, Asahi, Eli Lilly, Roche, Novartis, Johnson & Johnson. Companies with multi-billion-dollar R&D budgets.
Yeah, that's some serious competition.
Seriously serious. And dry AMD is similarly crowded with big players. The bottom line is, InMed has zero competitive advantages in terms of scale, brand recognition, or financial power. Their survival depends entirely on their science being truly novel and their patents holding up. It's a classic David versus Goliath situation, maybe even more extreme than that.
What about the regulatory side? That must be complex too, especially with cannabinoids.
Oh, absolutely. The standard FDA pathway preclinical phase 1, 2, 3 is already long, complex, incredibly expensive for any drug company. Then you layer on the cannabinoid-specific complexities. You've got the 2018 Farm Bill, you've got the FDA's stance on CBD and THC in supplements versus drugs. The FDA hasn't approved the cannabis plant itself, remember, only specific isolated cannabinoids like Epidiolex. Now, InMed's strategy here is actually quite intelligent. They're pursuing the formal drug approval pathway. If successful, that creates a high-value, legally defensible product, but choosing that path fully subjects them to the immense financial burden and the extremely high risk of failure inherent in that process.
And the barriers to entry for this kind of business, are they high? I assume they must be.
Astronomical is probably the right word. Think about the cost and the multi-year timelines just for the clinical trials. Hundreds of millions, potentially. You need incredibly robust intellectual property, deep technical expertise. And for cannabinoids specifically, there were historical hurdles like Schedule I classification, sourcing research-grade materials, even just getting funding. InMed has, to their credit, overcome the hurdle of creating the initial IP. But they now face the far, far more formidable barriers of capital and execution. Their ability or inability to raise the tens or hundreds of millions of dollars needed for clinical trials, that is arguably the single greatest threat hanging over them.
Okay, moving on from the business itself to the people running it, let's dig into Chapter 2, management evaluation. How does the leadership stack up?
Well, on paper, InMed does have an experienced team. The CEO, Eric A. Adams, he's been at the helm since 2016, brings over 25 years of experience. And their CFO, Netta Jagpal, joined in February 2024, has solid public company expertise. However, when you look at their track record, especially how they've handled crises, well, some significant red flags pop up for investors.
Red flags, like what? Give us some examples.
Okay, well, look at capital markets and the share price. Management has had to execute multiple reverse stock splits. There was a 1-for-20 split back in November 2024.
Ouch. That's never a good sign.
Never. It's a direct consequence of a collapsing share price, basically a desperate move just to keep the stock listed on the NASDAQ.
Right.
Then shareholder relations. A big red flag just recently, June 2025. They failed to achieve quorum for a critical vote on issuing more shares.
Meaning not enough shareholders even showed up or voted.
Exactly. It suggests either significant shareholder apathy, like they've given up, or maybe even outright resistance. Either way, it seriously complicates their ability to raise money in the future, which, as we know, they desperately need to do. And finally, financial controls. They actually disclosed a material weakness in prior audit reports. While this can sometimes happen with very small public companies, it definitely doesn't inspire confidence in the accuracy of their financial statements.
So, okay, they have relevant resumes, maybe, but their actual stewardship. It sounds like it's been a constant struggle just to keep the lights on. Is that a fair assessment?
I think that's fair. Their leadership tenure has basically been defined by a fight to keep the company solvent. You've got abysmal stock performance over the long term, friction with shareholders, these governance issues. They're all significant concerns.
How are they allocating the capital they do manage to raise? Is it going where it should?
Pretty much all of it is funneled directly into R&D. The primary use of any financing proceeds is pipeline development, which is appropriate given their strategy. That BayMedica acquisition back in 2021, that was really an attempt to add some revenue, any revenue, but as we saw, it's minimal compared to the cash burn. They have absolutely no capacity for any further M&A. And, of course, no dividends, no share buybacks. As a pre-profit clinical stage company, every single dollar has to go into the research. That part is appropriate.
Makes sense. But what about the return on all that investment? If you look at return on invested capital, ROIC, are they actually creating any value with the money they spend?
No, not even close. Their ROIC is consistently deeply negative. We're talking figures like minus 85% to minus 97%.
Wow.
Yeah. Basically, capital goes in and it gets consumed. It doesn't generate a return. Any investment thesis here relies entirely on some future hypothetical breakthrough producing a positive ROIC eventually to justify all the accumulated losses. It's all future potential, zero current return.
That brings us squarely to the hard numbers. So what does this all mean when we actually look at their financials? Let's dive into Chapter 3, Financial Analysis.
Okay, let's quickly recap some key metrics again as of June 24, 2025. Share price, $2.49. That tiny market cap, around $3.01 million. And the key financials. Trailing 12-month net income was negative $7.68 million. TTM earnings per share, negative $11.65.
Right, so big losses. What about revenue growth trends over, say, the last 5 years?
Well, they had literally zero revenue until fiscal year 2022. That's when the BayMedica acquisition happened. Then, yes, they showed spectacular percentage growth, nearly 280% in FY23, but that was from an almost zero base, remember. The absolute dollar growth was pretty modest. And now, that growth trajectory seems to be flattening out. Only 8% year-over-year growth in the latest quarter. This is just, it's not the profile of a high-growth tech or biotech business you might hope to see.
And profit margins. I think we know the answer, but are they even close to breaking even anywhere?
Structurally and profoundly unprofitable. That's the headline. BayMedica, the commercial side, does generate a gross margin around 32.4%, but even that's under pressure from competition, as we mentioned. But once you factor in all the R&D and operating expenses, their TTM net profit margin is a staggering negative 168.9%.
Minus 168%. So for every dollar they make.
For every dollar they generate in revenue, they lose about $1.69. Yes, the commercial business is nowhere near large enough or profitable enough to cover the huge costs of their drug development efforts.
Okay, let's talk free cash flow. That's critical for a company burning through money like this. What's the trend there?
Consistent and significant cash consumption. A very high cash burn. That's the story. Just look at the numbers. FY24, they burned through $7 million. FY23, it was $7.45 million. It's just constant outflow. And here's the critical detail, the really alarming part. As of March 31st, 2025, they held just $4.68 million in cash.
Okay.
Their quarterly burn rate is running around $2 million. So do the math. Management's own guidance states their cash runway only extends into Q3 2025.
Wait, let me get this straight. Q3 2025. We're in Q3 2025 in this report's time frame. So they're basically almost out of cash right now.
That's exactly what the numbers and their own guidance suggest. Think of it like a car running on fumes. They admit they've only got enough fuel, maybe, to get through this current quarter. After that, the tank is empty. This creates what they call a perpetual cycle of financing. Management is constantly forced to go back to the market, cap in hand, to raise more funds. And given their situation, those funds have to be raised under very unfavorable, highly dilutive terms for existing shareholders, this financing risk. It is, without a doubt, the most immediate threat to the company's survival.
Wow, okay. So financial stability seems like a non-starter. But just to cover the bases, what about debt? Earnings consistency.
Well, earnings consistency is easy. A long, unbroken history of unprofitability. There is no visible path to near-term profitability. None. Their debt-to-equity ratio is actually very low, around 12%. Now, normally, low debt is good, right? Financial health. But for InMed, it signals the opposite. It signals an inability to access traditional debt markets. Banks, lenders, they won't touch them. So they're completely dependent on the expensive, dilutive equity markets for survival. Their current ratio, that's current assets over current liabilities, it looks strong on paper, between 3.5 and 5. But that's incredibly misleading. It's almost entirely driven by their cash balance.
Which is rapidly disappearing.
Exactly. So it reflects fleeting liquidity, like water slipping through your fingers, not sustainable financial health, and naturally no dividend. That's appropriate for their stage, but irrelevant given the solvency concern.
Okay, so how do you even value a company like this? Traditional metrics seem useless?
Pretty much. Relative valuation metrics. PE is meaningless with negative earnings. Price to sales, PS, is very limited because, as we said, the market isn't valuing the tiny BayMedica sales. It's valuing the potential of the drug pipeline. So you might look at intrinsic valuation, like a discounted cash flow DCF model. But for InMed, doing a DCF isn't really about getting a precise valuation number. It's more of an educational exercise. It helps you model the potential outcomes, which are extremely sensitive to your assumptions.
So what kind of range does that educational exercise suggest? How extreme are we talking?
Extremely wide, basically binary. In a downside scenario, the failure case, where the science doesn't work out, the IP becomes worthless, and the cash runs out, the intrinsic value approaches zero. Total loss. But in an upside success scenario, if, against the odds, INM 901 really makes it through trials and gets approved, then the intrinsic value could be significantly higher than the current share price. Many, many multiples higher.
But the assumptions to get that upside must be heroic.
It's absolutely heroic. Key assumptions for any plausible DCF here would be, first, probability of success, POS. This is the most subjective but most critical input. Historically, the POS for Alzheimer's drugs starting from the preclinical stage is extremely low, single digits often, maybe 5–10% if you're optimistic. Second, revenue projections. You'd have to model zero revenue for maybe 7 to 10 years to account for the lengthy clinical trial and approval processes. And third, the discount rate, or WACC. It has to reflect the extreme risk involved. We're talking 20, 25%, maybe even higher. This heavily discounts any potential cash flows way out in the distant future. So yeah, any intrinsic valuation exercise here is highly speculative. It just reinforces the core idea. This is a high-risk binary bet on a single scientific asset.
Okay, so we've laid out the fundamental picture, a company with, some promising science, maybe but deeply challenged financials, and a terrifyingly short cash runway. But how does the market perceive all of this? And what does that tell us about the risks involved?
Right. Good transition. Let's shift our focus now to the market dynamics and the overall risk profile. We'll start with Chapter 4, Market Sentiment. First off, market perception. There's an almost complete lack of coverage from major Wall Street analysts.
Nobody's really following it professionally.
Pretty much. It strongly suggests the company is just seen as too small, too speculative for serious institutional investors. What little third-tier data exists actually shows a sell consensus, so that void. It gets filled primarily by retail investors, and that means trading is often driven more by sentiment, hype, and news flow than by sober fundamental analysis.
And that crazy pre-market surge we keep mentioning, nearly 100%, that's a perfect example of this retail-driven sentiment in action, right?
Exactly. That huge jump on June 24th, 2025, it was triggered by early-stage preclinical data for INM 901. That kind of extreme price reaction to very early news is a classic hallmark of a stock dominated by retail momentum and, frankly, speculative hope.
What other market indicators should we look at? Short interest, moving averages.
Okay, short interest as a percentage of the float is 4.42%. On its own, that's kind of moderate. But UT, and this is really quite astonishing, the short borrow fee rate is 435% APR
435%.
annually.
Annually, yes. That is exceptionally rare. It indicates absolutely extreme demand from investors wishing to short the stock. It's a powerful, powerful bearish signal. People are willing to pay an enormous premium, literally hundreds of percent a year, just for the privilege of betting against this company.
That's incredible. What about the price relative to moving averages? Did that news pop it up?
It did. The news pushed the price above both its 50-day moving average, $2.97, and its 200-day moving average, $2.89. Technically, breaking above moving averages can be seen as bullish, but given the stock's history, remember, it's down over 99% over the last 5 years, you have to view these technical signals with extreme skepticism. It's far more likely to be a temporary blip caused by the news than a sustainable trend reversal. Okay, now when we talk about who actually owns the company, that often gives us a clearer picture of confidence or, well, sometimes a profound lack thereof. Let's talk about Chapter 5, ownership structure.
Right. In a nutshell, the ownership structure is telling. Institutional ownership is negligible, maybe around 13.7% according to some sources, but possibly lower based on recent filings. Insider ownership is also very low, about 1.52%. This means the vast majority, well over 84%, is held by the public, by retail investors.
So negligible institutional ownership, really. What do the details show?
It's negligible, bordering on non-existent. The data shows only 6 institutional holders owning a tiny total of 6,414 shares. And here's a crucial detail. The largest reported institutional holder, Advisor Shares, they sold out their entire position recently, and UBS Group AG decreased its position by over 41%.
Wow. Selling out completely. That's not subtle.
Not subtle at all. It's a pretty significant vote of no confidence from the professional investment community. They're heading for the exits, or they were never really there in the first place.
What about the insiders? Management, board members? Are they buying?
Insider holdings are low, as I said, around 1.5%. But the key detail here is there have been 0 open market purchases or sales by insiders in the last 12 months.
0. Not even a small buy to show confidence.
0 buys, 0 sales on the open market. This lack of buying activity is a powerful negative signal. It suggests a profound lack of conviction from the management team itself, despite whatever positive things they might say publicly. If they truly believed a massive breakthrough was imminent, you'd expect some insider buying, wouldn't you?
You absolutely would. So this concentration of ownership in retail hands, combined with a tiny public float, what does that mean for how the stock actually behaves day to day?
It means extreme volatility. The small public float, only about 1.19 million shares available for trading, combined with that dominance by retail investors, is the primary reason for the stock's extreme volatility. It makes the stock prone to these dramatic fluctuations based purely on hype, fear, news snippets, social media chatter, rather than any slow evolution of the underlying business fundamentals. It makes for a very choppy, unpredictable ride.
Okay, finally, let's confront the multitude of risks that really seem to define this company. Let's get into Chapter 6, risk assessment. Can we do a kind of SWOT analysis? Strengths, weaknesses, opportunities, threats.
Sure, that's a good framework. Let's start with strengths, so they are few. The main strength is their science. The proprietary, patentable cannabinoid analogs, those NCEs, and that differentiated scientific approach targeting neuroinflammation. You could also list the experienced management team, though we discussed the caveats there. And superficially, yes, they technically hold more cash than debt, but we know how misleading and temporary that is.
Okay, minimal strengths. What about the weaknesses? I suspect this list is longer.
Oh, much longer. The weaknesses are profound. 1, extreme and chronic cash burn. 2, perpetual reliance on highly dilutive equity financing just to survive. 3, a very early stage pipeline with high failure risk. 4, low and declining margins in the BayMedica segment. 5, that history of reverse splits destroying shareholder value. 6, and the disclosed material weakness in financial reporting controls. It's a long list.
Yeah, quite the list. What about opportunities? The potential upside?
The opportunities are certainly there, and they are large. That's the allure. Primarily, the massive unmet medical need and market size in Alzheimer's and AMD. Billions, potentially tens of billions up for grabs. There's always the potential for a strategic partnership or even a buyout if their early data continues to look strong and they can somehow survive long enough. And more broadly, there's growing acceptance and research into cannabinoid therapeutics in general, which could provide a tailwind.
Okay, and the flip side, the threats. What external factors could derail them besides running out of money?
The threats are immense and varied. Let's break them down. General external challenges. First, intense competition from huge pharma companies with vastly greater resources. We talked about the Goliaths. Second, the extremely high risk of clinical trial failure. Most drugs fail, period, especially in complex areas like Alzheimer's. Third, that financing risk we keep hammering home. Inability to raise capital leads directly to insolvency. Game over. And fourth, the shifting and complex regulatory landscape for cannabinoids adds another layer of uncertainty.
What about broader economic factors, like inflation or interest rates? Do they matter to a tiny biotech like this?
They matter hugely. Inflation directly increases their operational costs, salaries, supplies, lab work, accelerating that already dangerous cash burn. High interest rates make it harder and more expensive for everyone to raise capital, but it particularly hurts speculative ventures like InMed. It also fosters a general risk-off sentiment among investors who flee from highly speculative stocks. High rates could be absolutely catastrophic for a company this dependent on financing.
In any specific geopolitical risks, like
Yeah.
trade issues?
Yes, potentially. Think about potential U.S.-imposed tariffs, for example, on active pharmaceutical ingredient, APIs, or other key materials coming from places like China or India. That would directly increase their R&D costs, further exacerbating the cash burn. These kinds of macro issues disproportionately harm smaller, less resourced companies like InMed that don't have the scale or negotiating power to easily absorb them.
It really is fascinating, isn't it, how all these different pieces, the science, the finances, the market, the risks, fit together to paint such an incredibly stark picture.
Exactly. It's a complex puzzle, but the overall image becomes pretty clear when you assemble the pieces. And that leads us directly to our final synthesis. Let's pull all these threads together now in Chapter 7. Conclusion. So, the bull case. What's the argument for investing in InMed despite everything? It rests almost solely on INM 901's scientific and commercial potential for Alzheimer's disease. That's it. The bulls point to the massive market opportunity, tens of billions. They highlight the differentiated scientific approach targeting neuroinflammation. They'll emphasize the promising preclinical data from June 24th. They'll note the intellectual property with those proprietary NCEs. And crucially, they'll argue that because the current valuation is so incredibly low, around $3 million market cap, any success would lead to astronomical multi-thousand% returns. It's a lottery ticket with a potentially huge payout.
Oh, yeah, that's the dream. Now, the reality check, the bear case.
The bear case is, frankly, grounded in what feels like overwhelming financial, operational, and statistical realities. First, extreme financial precarity. Perennial cash burner, desperately short runway, constant need for dilutive financing. Second, the lack of institutional and insider conviction. The smart money isn't there, and management isn't buying their own stock. That speaks volumes. Third, overwhelming competition. A microcap fighting against pharmaceutical giants, low odds. Fourth, extreme clinical risk. Alzheimer's is a graveyard of drugs. The historical probability of success from this stage is statistically very, very low. And fifth, the poor governance and operational track record. Reverse splits, material weakness, failed shareholder meetings. It does inspire confidence in execution.
So, summing up the valuation again, what does that leave us?
It leaves us with that stark binary range we discussed from the DCF exercise, the downside case. Intrinsic value rapidly approaches zero as cash runs out, the IP proves worthless, and the company becomes insolvent. This is, statistically, the most probable outcome. The upside case. Intrinsic value could potentially be many times higher than the current share price if they achieve that highly improbable massive success with INM 901. The current market cap around $3 million. It suggests the market is already pricing in a very high probability of the downside case, perhaps with a small speculative premium baked in for that lottery ticket-like chance of the upside actually happening.
So what's the final outlook? How should someone listening think about InMed?
Look, InMed is not an investment in the traditional Warren Buffett sense of buying a durable business with predictable earnings. It's simply not that. It's described here as a fragile, cash-burning enterprise. It functions as a pure binary speculative vehicle. Its stock price is going to be driven almost entirely by R&D news updates, its ability or inability to secure more financing, and the ebb and flow of retail investor sentiment. So the big takeaway for you, the listener, is this. An investment in InMed is a high-risk, high-reward bet on a single, very early-stage scientific asset. It is a wager that the company can somehow defy the long odds of both clinical failure and financial collapse. This kind of profile is suitable only for investors with an extremely high tolerance for risk, who also possess the discipline to size the position appropriately within their portfolio, meaning don't bet the farm, and who have the full acceptance that the most likely outcome is a total loss of capital.
That really puts it in perspective. And if we connect this specific case to the bigger picture, it definitely raises an important question for you listening. How do you personally balance that undeniable allure, that hope for a life-changing breakthrough, with the often brutal realities of biotech economics and, well, a company teetering right on the financial edge?
Yeah. This deep dive has certainly given us, and hopefully you, a lot to think about. It really illustrates the incredible volatility and the sheer level of risk inherent in early-stage biotech ventures.
And that wraps up our deep dive into InMed Pharmaceuticals for today. If you found this analysis valuable, please do consider liking this video and subscribing to the Stock Analytics AI YouTube channel. It really helps us out. And remember, members, for just €4.99, get priority deep dives on the tickers they suggest. We're actually covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those analyses. If you just want a one-off deep dive, like this one on a stock you're interested in, you can always drop us a super thanks. We appreciate the support. And finally, the important reminder. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.